Well, welcome to the show.
It's good to be here.
So you split your time between New York and Charleston?
I've been doing that. I'm moving to full time in Charleston. So
What interests do you have in New York?
just the people up there. I think one thing, and we come from a similar background. We went to the same business school together. There's so many people in New York, and the people and the conversations you have and just the topics you cover are so influential into how you think. When you go into smaller cities, you probably just don't have those connections. There's so much energy in New York City. The winters are tough, but it's an amazing place to live for a few months. It's hard to live there full time.
Yeah, it's a good city. There's an energy that's almost addictive. I do miss that, but Charleston's great. Charleston's amazing. The heat, it takes some getting used to. You were former corporate bankruptcy banker. Is that correct?
I started my career in investment banking, and then I jumped to corporate development and the
What's the
company I was
difference?
with. So investment banking is generally you're working on sell sides. So when you start your career in investment banking, typically you do a 2-year analyst stint, and you're going to be working with a lot of clients, depending on if you're at a middle market or bulge bracket. I was at a middle market. So you're generally going to be working on smaller company sell sides, call it between 50 to 250 million of enterprise value sell sides. And you're working with a lot of different clients, and you're kind of just a machine that's just selling companies. It's very similar to a real estate broker, but you're doing it for companies. And that's a typical investment banker. My investment banking program was a little different because I was on a coverage team for a large client where 90% of my time was spent on one client, which was a Fortune 500 telecom company. And then when my investment banking concluded, I took a job starting their corporate development group at that large telecommunications company. And when you're in corporate development, you're doing everything inorganic to the business. So you think about organic growth is we're going to get more sales, we're going to improve our operations, things like those lines. Inorganic is we're going to buy a company, or we're going to sell a company, or we're going to do a type of financing to raise new debt, or maybe we're raising equity, or it's kind of inorganic activities of the business to typically try to grow the business or make it more valuable.
Is the lifestyle true about 16, 18-hour days? You're up at 3 a.m. fixing pitch decks.
True in banking. In investment banking, especially your first year going into your second year, and then if you decide to stay in banking, you'll continue to be on projects. If you decide to leave, you'll kind of get taken off bank projects, so your second year is a little easier. But I think there was a year where I worked 364 of the 365 days. I got off Christmas was the only day the entire year I didn't work. And most of those days were full days. I will say, and I think everyone says this, back in my time, it was harder. My understanding is banking programs today have put a lot more constraints on what the senior bankers can put their junior bankers through. So it's no longer as bad as it was. But I think that everyone says it was worse in my day. But it's true that you get work to exhaustion. You learn a ton, though. I would recommend everybody, if they can, start their career in investment banking. Again, if you can get into a decent program or a decent analyst program, it's a great place to start.
So you hopped. What was the impetus for the hop?
So again, I was in a unique investment banking analyst job in that I was working for largely one client, which was the middle market bank I was at, their largest client. They did not have a corporate development group. And they decided during my, I guess, early on in my second year, we're just going to hire the head of the investment bank, the managing director in telecom. And then he brought me with him to start a corporate development group. And then the head of the investment bank became CEO of a company they spun out in. And then me and the MD started their corporate development group. So it was kind of one of these things where it was a very unique position where you could kind of jump in and be a fairly senior level role at a very large publicly traded company, largely 2 years out of my starting my finance career. So
Makes sense. And you were in Alabama?
I was in Little Rock. The program I was in was in Little Rock, Arkansas. And then the company I joined was also headquartered in Little Rock, Arkansas, which is funny because I'm a Northeastern guy, born in Philly. Never even been to Arkansas before I took the job. And then
How'd you get out there?
Took the bank job. It was the only job I could get. It's hard to break into these programs, especially I came from I went to college at Charleston undergrad, which is liberal arts school. It's hard to break into real investment banking programs if you don't come from a target school. And so it was kind of one of these things where I applied to hundreds and got into one. And it happened to be in Little Rock, Arkansas. So
Does College of Charleston have a finance program or a major?
They have a business degree. I think you can minor in finance, at least when I was there. They may have a major in finance now, but they did not have a pure finance degree when I went there. I majored in business administration.
Okay. What was your day-to-day in the corporate development side?
So Again, it was a fairly unique corporate development role. So a lot of corporate, like if you work at corporate development at Apple, most of your time is going to be spent on buying companies, or sometimes business development, which is kind of more product launches. Corporate development is more buying companies, but some of those times those roles overlap. My role at Windstream was more of a strategic role where I would be involved in buying and selling companies. I would also be involved in a lot of the product launches, a lot of the financial review from business units, kind of everything strategic in the company, which is one of the reasons I was so drawn to it, was you effectively day one have access to every single meeting in the company. Like I was going to every board meeting. And so you can see the entire company. We did a few buy side deals. We did a few sell side deals where we were selling a business unit or selling a product line to a strategic buyer typically. Also a lot of capital structure, raising debt, raising equity. We had a unique capital structure where we spun our assets into a REIT, a real estate investment trust. We were the first telecommunication company to ever do that. And it ended up being kind of a nightmare, but it made the role certainly interesting from my end because a lot of it was involved with negotiating with the REIT, negotiating various agreements with the real estate investment trust that owned our assets.
And real quick for the listeners, the difference between the sell side and the buy side.
Sell side is, I mean, it's very similar to a sell side and buy side broker in real estate, right? Your sell side is we're selling a company, we're selling a business line. Buy side, we're buying a company, we're buying a business line. When you think of investment bankers, you typically think of them as in the sell side process. There are buy side investment bankers, but they're not as prominent. When you think of buy side, it's typically on private equity. That's when people say, hey, I'm going to the buy side. It typically means I'm going private equity because they're buying companies in their portfolio through typically a fund.
Companies like Microsoft or Salesforce, they're always acquiring either competition or strategic acquisitions. Is that the focus of what you did?
I would say it's probably maybe a third or half my time. We did several deals. We would probably do one deal a year. The difference with my company is we were not looking at pitch decks. So generally, most corporate development groups, you'll be getting a lot of, especially someone like Microsoft or Apple, you'll be getting a lot of banker outreach that says, hey, we have this small strategic that we think has a good product that would fit kind of in your company. Do you want to buy them? For us, it was a lot more strategic acquisitions to either grow our network size, to bring a customer base in, to kind of synergize on our existing network. We weren't in the buying products. We had those discussions, but we weren't like buying new products. Because again, we were a telecommunication company. Our product line was largely set. We were not kind of getting into these adjacent services, but we were doing, I mean, we did several $billion deals where we would buy another telecom company and bring them onto our network. And by doing that, you synergize their network assets and you can kind of increase their EBITDA, their cash flow. And that's a lot of, especially legacy companies, a lot of the deals they're doing are going to be strategic in nature where they can realize synergies. When you're talking about a lot of these software, and I know Apple's not a startup, but they're doing both. They're probably doing some synergistic acquisitions, but a lot of like buying in new products, startups, things like that. Especially with like OpenAI. OpenAI has its own entire group for just buying up AI startups.
So your day-to-day was doing the due diligence on these acquisitions and then forecasting. Where did you pick up in the process? I know you said there was some business development there. So were you prospecting, due diligence, proposal, close, and then the handoff to a group for acquisition?
Yeah, I would do everything through close. And then typically we would have a full integration team. We call them IMO, Immigration Management Office, where you'd pass off your deals to them. You would basically pass off, here's the product plan, here's the synergy plan. And then you'd pass it off to that team. That team would integrate your plan. And you would remain in kind of the meetings, but you wouldn't be day to day involved with integrating. So a lot of it is like, how do we integrate our network assets? How do we integrate various sales teams, product teams? And my role would be have the high level strategic plan and then pass it off to the more detailed team to execute.
Do you think this continues in perpetuity? Is there always going to be new companies to acquire or legacy companies to acquire?
I think bankers and lawyers need to get paid. And I think you make a ton of money for bankers and lawyers doing deals. There's been research that says most M&A deals are unsuccessful. I think it depends on how you look at the data, but there are, depending on your industry. I know in telecom, there are meaningful value to combining large businesses because again, you can eliminate a ton of network assets. It helps from a cash flow perspective, but it helps also from a customer service perspective. Now you're able to offer a bigger network. I think what T-Mobile did, like T-Mobile now has this massive network through, most of the acquisitions. Same thing with Verizon. Same thing. These companies didn't just, a lot of it they grew organically, but a lot of it grew through acquisition, and now they can offer nationwide services. I do think that's always, and there's always value in scale.
Which is interesting because T-Mobile can't acquire SpaceX, but they have a partnership or JV with SpaceX, right? Because they offer Starlink text messaging to all of their customers.
Don't they offer connectivity to the actual launches? I'm not familiar with exactly that, but it's probably, there's also probably an anti-compete there.
Here's my question is, yes, you could do a partnership with T-Mobile and Starlink for T-Mobile's customers, but you can, on any carrier, sign up for Starlink Connect through T-Mobile for like $10 a month or something. So they don't own Starlink or SpaceX, but they have a JV, but then they can also sell the service to non-T-Mobile customers. It's interesting.
Yeah. A lot of those strategic partnerships are effective sales agreements. Either one company is using the other company's customer base, or they're both using each other's customer base and then combining products to increase sales volume. T-Mobile does a lot of that. I know T-Mobile partners with landline telecommunication companies to basically sell their fiber into the bundle of the cell phone, and they bundle it up. And they've had success with that. Again, generally, most people think if you have multiple services in one kind of customer agreement, it makes it stickier and it kind of makes it more valuable. You can charge more, but it also less churn. So I think a lot of these companies are trying to use strategic partnerships to increase the services they're offering customers, which again, I think a lot of this stuff is people have a lot of time on their hands and they're trying to create value propositions. But a lot of it works, but a lot of it, who knows?
Over the next 2 to 5 years, how many bankers and how many lawyers are going to be replaced on these deals? I know there were deals like Spotify who listed directly without underwriting from investment bankers. What is the difference between hiring an investment bank and just direct listing?
We went through this. My company went through restructuring. Then we decided, do we want to go public? Do we want to remain private again out of restructuring? I wasn't a equity banker. I don't know this exactly, but an IPO, you're effectively selling float to initial investors and you're creating a market. Direct listing is you're directly going to the exchange and listing your equity. You're not selling that float. And then over time, you can build up kind of your publicly traded float. You generally have less fees on the direct listing. I think most people would say that direct listings are less efficient in pricing because you don't have that initial kind of like sales package. I do think from your point on bankers and lawyers, I think the bigger deals, probably less so, just given the work is a lot more complicated, especially on the banking side, to eliminate them. Lawyers, and I'm not a lawyer, so I probably have less knowledge on what makes their work so specialized, but it seems to me like lawyers are going to be gone. I know a lot of the deals I work on today, again, they're a lot smaller, but I'm using Claude for everything. And then maybe a lawyer to read through, but I'll ask Claude to draft the entire purchase agreement. And a lot of times it will do it better than a small time lawyer.
I think where Claude has some trouble, or Grok, is still the finance piece. Say if you're building a DCF or a WAC, it still has some issue with calculations and just giving you what it thinks you want to hear versus actual calculations. What it's good at is checking formulas, formatting maybe, but I still think we're a few years away from being super accurate when it comes to calculations. But lawyers, you can draft agreements, you can draft anything from, like you said, purchase agreement to, I mean, you want to have an attorney look at an acquisition, but
a lot of lawyers are going to listen to this and be like, these idiots. Like,
I mean, good luck out there.
It's true. Like, it's true. I like, you can iterate with, again, I use Claude and ChatGPT, mostly Claude for business work, but you can iterate legal thoughts. And I know even like tax, like I'll ask a question on tax, and I know a decent amount of tax, but I'm not a tax expert. I know enough to be able to continue to iterate until I get to like a really solid understanding of what I'm trying to look into. And then you relay those questions to some expert who actually knows, hey, here are the questions that basically I was able to get to that Claude couldn't answer for me because of unique circumstances to my company that Claude just didn't understand. And then it allows you to kind of like lead your lawyers or your tax accountants, whatever it may be, to kind of like the actual answer, not lead them the answer, but give them the real question you're trying to ask and not have to go back and forth to them 6 times and rake up a giant bill.
So back to the question of, does AI replace middle market, lower middle market in the next 2 to 5 years?
I think the issue I keep running into is senior bankers is a relationship business. And I don't know how much those relationships are going to be replaced by AI. But how do you become a senior? A lot of the lower level work, I think you can make an argument that it will be replaced. A lot of the analyst work, even the associate work, pitch decks, certainly pitch decks, they already can do it. A lot of the modeling, depending on how nuanced it is, it can be done. But how do you become a senior banker if you never have to go through the 10 years of being a junior banker? That's what I don't understand. And then does your training programs become entirely different? Because again, it's the senior bankers, they all know the junior stuff. They don't, in meetings, you won't see them going through modeling questions, but they know the model. Because they've done it for 10, 20 years. And then in the meeting, they can kind of bring it up to a high level where they're answering the clients the question, the questions the clients actually need to know. They're not answering what's your whack. But how do you get to that point if you never go through the junior? I don't know the answer to that question.
That's a really interesting question. It's also on the other side, on asset management. A lot of the asset managers are aging out and there's no new, younger asset managers. And so does AI replace that? We've seen a move towards robo-advisors. Now, do people want that? Or are they pushing robo-advisors so that they can charge a premium to talk to somebody? I mean, that could be a strategy too, right?
And I think I will say a lot of asset managers' job is when the stock market's tanking, convincing their clients not to sell. It's calling them up and easing them, hey, this happens, markets have downturns. A lot of the asset allocation and diversification or tax harvesting strategies, that's all automated. It's already largely automated today. It's only going to get more automated in the future. But the value of having an advisor is the personal relationship. Again, it's the same thing with a senior banker. It's the personal relationship with the client to convince them when things are going to hell, it's going to be okay. We've thought about this and protected our downside, but who knows? It's funny. Like in my head, I think the fields you don't know very well, you assume are going to be automated because I'm like, detail M&A diligence will never be automated. And then everything I don't know well, it's like, oh, that's just going to be automated. But so there probably is nuance in every single little subject line that people who aren't experts in it aren't thinking about that AI won't be able to automate. Because I would never hire somebody and pay them, 60, 70, 80 basis points on my assets to tell me how to allocate, right? I'm just going to buy little or, whatever it may be, depending on where you are in your life. But it's an interesting time. It's certainly interesting. I mean, things are changing so much. I know we're going to get into this small business stuff, but it's one of the exciting things I think about investing in kind of these like blue collar small businesses that I've been doing deals in. Well, I'm saying to me, it's like so hard to automate some of these. And if anything, AI is going to make them more valuable because you can make them a little bit more efficient, but you can't automate the actual work. It's not like a Tesla robot's going to come in.
Well, even then, a Tesla robot, I was just having this conversation of Tesla robots or figure robots. Are they going to replace house cleaners or car wash staff? And if that was the case, we would see landscapers dropping off automated lawn mowing equipment and coming back an hour later when it's finished. We don't see that. There's a battery energy capacity issue. There's a logistics issue. Just to have inventory, how many of these electric lawnmowers and autonomous lawnmowers do you have to have just to get to break even? Energy bills, battery replacements. There's so many things. So you look at a Tesla robot or figure robot, how long can it work for? I don't think this is a zero-sum game. I don't think a criminal wants a full-blown AI criminal defense attorney. I think they want AI plus a criminal defense attorney. And exactly what you're saying on these M&A deals, you still want a human guiding the ship here. You still want to check the hallucinations of the AI, and you also want to make sure that things are flowing. I don't think I'd get on an aircraft yet with no pilots.
Yeah, I think the data would say it's safer to get on one without, maybe not today, but certainly in 5 years, the data would say it's safer to get in a robo-taxi versus an actual Uber. But it's still a little bit odd. But I think you're getting used to that. Like, I think Waymos, I haven't been in a Waymo because they're not really on the East Coast yet. But everybody says the first time you get in a Waymo, it's like, what is this? And then after you've ridden it 3 or 4 times, you're just used to it, right? And I think that's probably how a lot of these things go, is like the first year, you're like, this is so strange. And then you're just used to it. And who knows? I mean, you go back to like your legal defense thing. You could make an argument that both the prosecutors and the defense are AI, and they've already had their like arguments before you even go to trial. They're like, it's all AI arguments, and then there's just an automated verdict without even having to go through the trial because they've already done it all. Like, why do you even need to go through a trial if both your prosecutors and defense are AI?
Which is scary because when you prompt AI and you're like, hey, you're wrong here, and all it says is, oh yeah, sorry, I overlooked that. So
Yeah. It's getting better at that though. Like
It
2 years ago, every time it was like, you've missed this. Now it's like a lot more nuanced on what they've missed. At least what I've found. How much better it's gotten in like 6 months is insane. It's absolutely insane.
To go back to your Tesla Cybercab, after a year of doing it, you get used to it and it just becomes a norm. I remember it was 2013 when I moved to New York and somebody called an Uber and I had no idea what Uber was. And I was like, wow, there's a driver. You just have a driver. And they're like, yeah, you haven't heard of this? And so now it's super common. So Waymo, Cybercabs, and continuing that with robots in homes and implementing robots into businesses and warehouse. I think that's where we're going. And the other question is, are cars going to even have steering wheels in 10 years?
Yeah, why do you need them?
Why do you need them?
Is it just like a living room? You just basically have a box structure with a table and, I mean, or just like an office, and your car is effectively an office at that point. But it's an interesting world. It's definitely a lot of things are changing, and I feel like you got to stay on top of it, especially with some of the business stuff, trying to incorporate these tools as much as you can. It's been a game changer for some of the businesses I own. And we are in very legacy industries where we're certainly not at the forefront of some of these changes. But
yeah, let's get into that. You went from banking into working for yourself. You search and buy blue collar businesses.
correct. So I went investment banking and then I did corporate development for 8, 9 years. I led corporate development at Windstream for 6 or 7 years. While I was at Windstream, I started doing some side investments. I think typically how people start doing, they start investing in the stock market. They figure that out and they're like, okay, let's start doing private equity funds. And then they start doing that. And then let's do like crowdfunding the real estate deals. And you start kind of working your way down kind of the potential investment opportunities. And in 21, I guess when I was at Wharton, I guess a couple years before you started, first year there, I bought a residential HVAC business. So before about a 40 employee, I bought it with a partner.
What state?
In West Virginia. And it was kind of out of the blue. I wasn't even really searching. I was close to a couple other deals. I had an LOI signed for a mobile trailer park, which that space is blown up. I should have done that deal. I was kind of an idiot for over negotiating. We'll get into this. I think that getting these deals done, if you find a good company that at a good valuation, just get the deal done. It's so hard to find them and it's so hard to close. Like over negotiating these little deals is the biggest mistake you can make prior to close, because you'll lose something that could be a really good outcome by just trying to negotiate a few $1,000s on a working capital peg or something like that. But any event, so it was kind of looking at a few deals kind of while I was working at Windstream, and through my network, this HVAC company got brought in. There was a younger guy who just graduated college. He lived in a smaller town in West Virginia, and it was a family-owned business that he knew growing up. And the owner, they had agreed to sell it to him. He needed basically someone to fund the equity gap. And I remember he was actually the first person I called. I was the first person he called looking for a funder. You hear about HVAC now, and it's like the company's blown up space. Everyone's looking at them. And I remember on the call, 5 minutes in, this kid I have more respect for the guy doing this than almost anyone. At 23, he had a full model built, full pitch deck, thesis on why he wanted to buy it. By the end of the 30-minute call, we had committed to buying it together. We closed on it. We used an SBA funding. I know we can get into this. A lot of the first deals, it's really hard to do them without SBA, just given the capital requirement, unless you have family money or some other way. Pretty much everyone does the first deal through SBA. That process can be a little bit onerous. You got to go through a bank. It takes about 6 months. So we had a deal signed and we couldn't close it for probably 6 months after we actually agreed to the deal, which was a little bit frustrating because we couldn't start operating it. I think we closed in 2021. It was about 40 employees. And
so through COVID, did that impact the deal or the valuation?
A little bit. And again, going through the over negotiation is we were kind of looking at inventory.
Break that down. Break that down for us. What does that mean, over negotiation? Is this just overlooking everything, combing through everything, or is this getting the seller to understand the correct value of the company?
It's probably both, but I think the issue is you're generally working with a seller who's not overly knowledgeable. And this deal was proprietary. He didn't have a banker. His accountant was representing them. And I was coming from big M&A, right? I was used to working. Most of the times when we sold a company, we would be selling it to a large private equity fund or a large other strategic. And so you're dealing with people on the other side who know everything you're telling them. So when you're negotiating these finer points, they know where the value is, you know where the value is, and you're really just kind of agreeing how you split that value. In these smaller deals, they just think if you try to hard negotiate smaller points, they just think you're trying to screw them because they don't understand that their point doesn't actually make sense. And not in a bad way. Like, for instance, working capital peg, where you'll close on a deal and you'll agree on how much accounts receivable comes with the business. Accounts receivable, payables, whatever, maybe other working capital items. And then how do you set what's the targeted amount of how much accounts receivable comes to the business? The seller will generally say, hey, I sold those accounts receivable. I should keep them. Generally, in most institutional level M&A deals, there's some peg where it's like, well, the business has to have some amount of the AR to continue working, and that stuff like that. Well, you'll negotiate. Again, it's in these deals, it's maybe $5,000-$10,000, which is not large compared to the overall deal size, and you may just negotiate that so hard where the buyer's like, I don't want to work with this guy. And there's other points too, right? There may be lease term agreements on the building. There may be a fixed asset list of what assets are coming, or inventory that exchanges hands, or the interest rate on the seller note. A lot of these points that are largely inconsequential in the deal, or non-compete sometimes. You could make an argument that non-compete isn't inconsequential, but whether it's a 50-mile non-compete or a 100-mile non-compete may be inconsequential. The biggest regrets I've had is where I had a really good company and I've over-negotiated with the seller and we've lost it. And I think I'm learning as I go on, what are the key points that I need to have to make this deal successful? And the other ones, just kind of let them go. Obviously try to do, negotiate them fairly, but don't try to win every single point. And also you're working with the owner after. Typically in these deals, you buy a company and the owner will stay on for a year or two. So, and they're so key to the business. Yeah. And they know all the employees. So it's so important to keep that relationship too. And so if it means giving them some of these points, just do it. The other thing that kills these deals is these extended timelines. And if you're negotiating all these points heavy, it means another has to go to his lawyers, comes back to your lawyers. There's a couple of weeks. So it's kind of just like, I'm almost like the deals now where it's like a gentleman's handshake and you kind of like paper it on a 10-page merger agreement. The reality is like, what are you going to go back and you're going to have a recourse on a seller? I mean, you're hoping you're working with really good people. And generally, if you don't trust the guy you're working with, don't do a deal with them.
I'd like to back up and just give an overview. But to that point, there was a professor at Wharton named Chelfin, and he has a whole class on entrepreneurship through acquisition. One of his due diligence tabs are to go to the place and meet the person. Do you trust them? Do you have a good vibe around them? Look at the place. Is it a mess? Is it tidy? Is it organized? I mean, these are basic things that really tell a lot about the owner. But let's back up a little bit. So you bought an HVAC company. What deals do you look at? The normal person, if they're in their day-to-day job and they want to side hustle, say a laundromat, because I've had these conversations or I've heard this so much, but they have a day job, say they're a nurse or they're a lawyer. What deal size are you looking at and what deal size is normal for the lower?
Well, I think as you go up, obviously looking at bigger deals, it probably depends on your funding ability. I think it typically on the first deal, the governor of your size will be the SBA loan, which again, we raised it 5 years ago, but at that time, the limit was $5 million of debt and they could fund up to 90% of the purchase price. Generally, most banks won't give you the full 90%. So you got to think about it. Effectively, $5 million is your max enterprise value of buying a company.
And enterprise value is purchase price.
Enterprise value is purchase price, correct? Yeah. It's how much I bought business for. So that's generally the governor. So typically, and depending on industry you're in, call it, $1 million, the cash flow is going to be your kind of top end, maybe a little bit more than that, depending on the industry. But I will tell you, and this is and you've seen this because I know we've talked about deals together and you're trying to do some, it's become so competitive. All of these spaces have. I mean, the home services is like insane how competitive it is. All these private equity funds are coming so far downstream that buying an HVAC business today, $1 million HVAC business today, good luck. You're going to be in a competitive, especially a pure resi that's like, the in-demand HVAC businesses. You're going to be in a process with 30 other private equity funds that have $200 million funds and already have a strategic in the market. And it's like, you're going to try to outbid them with your SBA loan. Like, you're never going to be able to do it. So I think if you're an individual trying to buy a business, you really need to find a niche that other people aren't, and we can go into this, that other people aren't looking at, either a niche in industry. Like, I'm going to go in an industry that isn't this super attractive private equity industry, like home services, like HVAC in particular. Or I'm going to go into a market that no one wants to go into. Or the best case is you both. You go to like a niche business in kind of a more rural market. And the issue there is most people, especially type A driven younger people, don't want to go live in like rural Alabama and run a transmission business. That's where you find actual real deals that you can close, is have a unique angle that other people aren't looking for.
And I think it goes back to our point about AI. This is where you can really lean on your relationships, because how do you compete with private equity? Well, I've come into conversations with some business owners that say, are you private equity? No, I'm not. Okay. I don't want to deal with private equity because I care about my employees. I care about the legacy that I'm going to leave and the business that I built. And I don't want this to transition and ripped apart. And so I think that's where you can
relationship. The relationship,
it goes back to relationship.
Seller.
Right.
Yeah. Build a relationship with the seller
or your network, even to source
network,
the deal.
That you're a good guy. Like, you're not going to fire the employee. I mean, the reality is these employees, most of the small businesses, you're buying those relationships with the employees and their knowledge of the business. A lot of the like processes and things. I mean, you have a product you're selling or a service you're selling, but making sure all those people are happy in the transition is the number one factor, whether it's going to be successful or not. From the owner all the way down to like the secretary or whoever it may be, you want to make sure all those people are happy and they enjoy working at the company, and that's what's going to make these successful longer term. So,
and they can participate in the upside of the company. So to find these deals, we just talked about relationships, leaning on your network, calling all of your friends and family, asking people if they know of anybody. How else do you find deal flow?
Yeah, I mean, it goes back to the point. It's gotten considerably harder in the last 5 years while everyone and their mother is trying to buy small businesses. But there's obviously public brokerage listings like biz buy sell. I think there's still opportunity in biz buy sell for lesser known industries. If you see an HVAC business on there, don't bid on it, because it's probably, there's a reason that they're listing it there. But if you find these kind of lesser known industries, there's probably still some value there. I think we're about to potentially execute an LOI on a business, on a transition business we just found on a biz buy sell that we think is pretty good value. So it's generally like telling people, I'm looking to buy a business. Like, do you anyone know that buy? Then that's what Chafflin, he would always say that, right? How does he find them? He tells everybody he knows that I'm interested to buy a business, especially people who are CPAs or have relationships with business owners, or people in maybe your parents' neighborhood, or even people at the gym, or this is what I do. This is kind of my business, because your network is going to lead you deal flow. And I think a lot of people, again, it's becoming more mainstream, the idea of buying these and as like a job or as an opportunity. But still a lot of people are like, wait, what? How do you do it? And especially people who aren't in the business world. So I think just letting it known, like through your network. How are you looking at deals? I know you're kind of going in all your spaces.
So I'm finding deals through either network or cold calling. Just old school. Yeah. You call and you have a pitch ready to go, and you perfect your pitch. It's not the best pitch on the first business, but on the 100th or 200th business that you call, your pitch is getting pretty good, and you know what you're looking for. I haven't found anything through any of these listing sites that have been worth the due diligence process, but I also think finding one or two really good brokers. I haven't had great luck with brokers, but I've found two. They're M&A shops. So I call M&A shops and I say, hey, I'm in the lower market. Do you have anything that's below your minimum that came across your desk? And I've got a few deals doing that. I found a few of those.
Yeah. And then I think being prepared to close when you find one. Again, it goes back to like, these are so hard to find that when you find a good deal, and I remember last year I had a very good company in Charleston under LOI, 3-location auto repair shop. And I just wasn't prepared. I guess I wasn't in the headspace. Do I want to like do this in Charleston? And if you're going to like win these, like you're going to have a relationship with the owner, you go get lunch with them, you find a deal, the valuation makes sense. Just be prepared to move fast. You have the capital. You've already kind of maybe had discussions with SBA or however you're renting your money, where you're not like, I want to buy your business. And they say yes. And then you say, okay, well, I'll get back to you in a couple months when I've like figured out if I actually want to do this or not.
So once you find or have deal flow, and then you identify one or two or three, what's the next step? I say NDA signed, You have access to the data room. What do you look for?
The first thing I look for, especially if they're like public market deals on a biz buy sell or something, is validate the financials that they presented. And I would say 9 times out of 10, they're overstated. Where you do that, you look at 3 years tax returns and just say, did you make the revenue that you said you made? Because you'll have to report sales in your tax returns. And then look at their cash. How has their cash trended year over year? They say they do $1 million of cash flow a year. Has their cash gone up by $1 million a year? If it hasn't, why not? Are they distributing out $1 million to the owner? Then maybe they are actually making $1 million of cash. Or has their working capital gone up every year? And it's like, wait a second, this business actually isn't making $1 million. They're putting it all back in CapEx that isn't growth, or maybe they're not even making $1 million. Maybe that's just a made up number and their tax returns don't even show. So it's like validating that the numbers, and that you can do that once you get good at it in 30 minutes, right? It doesn't take that long to just look at a couple numbers and see if they're going in the right direction. And then I think it's probably, for me, again, the biggest thing I think in any business is validating unit economics. Do they make sense? Is there a sustainable demand in the market so again, when I say unit economics, you're selling a service. What are you selling it for and what does it cost? And what's the margin on that? And that's the unit economics of every sale. And there's ways to define them. Do you include marketing costs? Do you not? But generally, it's like, when I sell a good, how much do I make off of it? And then, is there a sustainable demand in the market at that price to drive the business, long term where you want to go? That's like the biggest thing to me is I validate their cash flow and I validate what are they actually selling and does it make sense at those prices long term to kind of create a business.
How do you break down cash flow? Do you build your own cash flow statement?
I think early on my career, I would build like these big models. I don't do that anymore. I think now I just look at their tax returns and just basically say, what did their cash go? Like you look at their balance sheet, right? What is their cash number on their balance sheet at every year end, maybe for maybe 3 years? What is their accounts receivable? How has that gone? You can define this as what working capital. Do you add working capital in the cash flow? You take it out. I think it depends on if you think it's actually true that you'll receive that long term. Again, generally tax returns are pretty solid, but you look at how is that cash change from year over year? And then if it's not going up as you would think it would, why is it not going up? Is it because they're distributing? A lot of times you'll have an owner, he'll keep it easy, $1 million of cash in a year. And then at the end of the year, he distributes $1 million out to himself. Well, that's real cash flow, right? Because that means the owner got that money out of the business. But if he's using that money in something else, right? He's investing in CapEx, or, the reason he made a lot of money was because his accounts payable went up by $300K. Well, that means that he's not actually making the money. He's just not paying his bills. And so it's like a lot of balance sheet work. Honestly, like the balance sheet when you're validating cash flow is almost as important as the income statement. Again, the income will define how much, I don't want to get into technical, but how much is like his equity goes up. But there's equity roll, right? So a shareholder's equity roll is you start out as your beginning shareholder's equity. You see what he's made in the business through his net income. What has he distributed out through his dividends? And how has that changed year over year? And then you can define like what is actually the real cash flow of the business. And then that's why, again, balance sheet is like super important. I think income statement is very important to figure out how can I optimize expenses? Where's revenue? But I think from a cash flow perspective, the first thing I always look at is balance sheet.
And it also shows debt, how much debt.
How much debt. That's the other thing. Has he made a lot of money because he took out $1 million of debt? And so like, oh, my cash balance went up by $1 million, but that's just because I pulled out $1 million loan. You haven't really made any money. You just taken out debt. So it's a lot of these things kind of combined together. People going in these businesses, that's where maybe you want someone to kind of help you and validate some of this. And that's what some of these deals, they'll get what they call a sell side Q of E, which is basically an accountant will come in and validate a lot of this work for you. They'll do some customer economics as well. But that's where, again, if this is your first deal and you're taking out SBA, personal guaranteed SBA debt, maybe pay 20 grand for a sell side Q of E to validate what you're seeing, just as kind of a protection for yourself.
So once you find and verify cash flow and you've looked at the balance sheet, the income statement, the cash flow statement, what are you then looking at? Are you building a DCF, a discounted cash flow statement? Are you building your own WACC? Are you looking at optimization, operations of it?
No, I think maybe I used to. A WACC in a small business it's kind of almost irrelevant, right?
Can you explain a WACC?
Weighted average cost of capital. Really, it's how much what's the cost to raise capital? And when you say average cost of capital, what does it cost to raise your equity? What does it cost to raise your debt? So maybe SBA debt is generally 10, 11%, I think today. Equity is going to be something a little higher than that generally. So maybe a weighted average cost of capital for a small business would kind of be in the teens. And so a conventional DCF would say you model out your cash flows and then you discount it back using that WACC. And that's what the value of the business is today. I think it's a good exercise to potentially do to kind of see. I would probably focus more on what is my debt I'm taking out? What does my cash flow need? Cover that debt plus some just for downside scenarios. And so that's a lot of my modeling is like kind of like what is the cash flow? And generally year one, you're going to have to do a significant amount of investment to kind of get the business where you want it, whether it's, build a new website or, buy new lifts if you're doing auto repair or whatever it may be. And that's going to eat a lot of your cash flow. So you want to make sure that you kind of have a little bit of cushion, and you either can have that cushion through operating cash flow, or you can put some cash on the balance sheet at close to cover some of these year one, year two expansion plans. So that would probably be more what I'm thinking about is like, how do I make sure that especially if I'm doing SBA, is like make sure that I am going to be able to make my SBA payments. And then, if you're taking out seller note, make sure I'm going to make my seller note payments. Because the worst case scenario is you buy a business, the first 2 months don't go that well, which generally there's a lot of like the first couple months are always going to be a little hard to transition. And you don't have cash flow, and you run out of cash. That's the worst. And then how do I get more cash? Well, I just took SBA debt. No one's going to loan me money below the SBA. So now I'm like kind of stuck. I'm in this liquidity constraint. That's the worst case scenario. So you want to be generally very conservative on cash flow forecasting. And I don't really think about it as a value. It's very hard to value these businesses and it's so like volatile, right? Like you're going to have, you get a 50x return, or, you could lose all your money, right? So it's like, how am I going to, what's the point of doing a DCF on outcomes like that? It's just so volatile. It's almost worthless. You kind of just think you want to have confidence in 3 years, I can get it to here. And that's where it goes back to like, what's your unit economics? What's the market you're selling to? Is there excess demand in the market? And when I say that, I mean like when we bought the transmission business a couple of years ago that rebuilds transmission and used vehicles. The first day we called, do you guys we don't have a website. Do you guys do any advertising? We don't do any advertising. What's your wait times? We're usually booked out 2 weeks. Yeah. So you're booked out 2 weeks. You don't do any advertising. You don't really have a website. They had a small website, but you don't really do any digital presence, and you're booked out. That to me means excess demand in the market. The price you're selling at is either a very competitive price or even below market price. And you have a service that customers really want or really need in the case of transition rebuilds, because you need your car. So, and that's kind of what I'm looking at. It's very hard to know exactly where those outcomes are.
With businesses that are owner dependent or have a high customer concentration, do you put those aside? Do you even look at those, or do you see opportunity there? Because I think a lot of these baby boomers that are retiring, or these small businesses, blue collar businesses, are owner dependent.
Yeah, man, I think it just depends on kind of where you want your role to be. Because a lot of, especially when you go super far downstream, you're really just buying a job versus a business. Like if you're buying a business that earns $100,000 a year and you take it over, you're really just buying yourself a job, because you're going to replace your owner. And then, but that's not the worst place to start, right? Like if you like the market, it gets you in the door. And then if you have confidence that you can kind of execute, you can grow it from there. It obviously depends. Do you like the brand that you're there's a lot of dependencies on that. The two biggest issues I've seen is customer concentration. You have one customer that's 50% of your revenue and he leaves. That like destroys businesses. So that's like either you want to protect that through a seller note, or you want to just avoid those businesses entirely or use it in your valuation. Like that's a big risk. And then owner dependency, where the owner's cell phone is your kind of pipeline to all your customers, and the owner leaves and you forget to include his cell phone in your kind of asset list that comes with you, or cell phone number. And suddenly now all your customers out the door as soon as the owner's kind of 6-month consulting period ends. But you have to get comfortable with it. There's never going to be perfect deals either. So it's kind of like some of these things where you can work through a lot of this.
Explain if there's a high customer concentration and implementing a seller note.
So generally in this, the one thing I like the reason I think home service businesses are so valuable right now to institutional buyers is it's all consumers, very little customer concentration. You're not at risk of losing one of your big customers. Where you'll see customer concentration is maybe like home builder relationships, where you're maybe a land developer and you sell your land to a home build, one or two nationwide home builders. Maybe it's in like a manufacturing business where you manufacture, X product and then you sell them to a list of 3 or 4 customers. And so that means the issue, what you're running into is you have your revenue, you have your gross margin and your variable economics you sell it for, but then you have a set overhead, right? All your your sales team, your front office team, your rent of your building, that's going to be the same regardless of what your revenue is. And so if you have 50% of your revenue with one customer, he leaves you. You're not losing 50% of your cash flow. You're losing dramatically more. You're going to lose all your cash flow because all that overhead's not coming out. In the seller note, again, if it's 50%, like that's something where you want to have confidence that that's not going anywhere. But when I say structure a seller note is you say, hey, I'm going to buy your business for, I'm making up numbers here, $5 million. 50% of your revenues with this customer, $2 of the $1 million will be a seller note that's kind of contingent on this customer staying with us in its current capacity for 3 years. If this customer leaves, like if half his revenue leaves, half that seller note's gone. And then you can kind of like, and again, you can kind of change with those numbers depending on how confident you are in the customer, how much it means to the business, et cetera. Then you're structuring your deal where if that customer does leave, you effectively just cut your deal price in half or whatever the math is, and it protects your downside. That's generally how I think about it. Again, it's really hard to negotiate those because the seller is going to say like, well, what happens if you come in and first day you curse off this customer on a phone call and he leaves? That's not my fault that you just pissed this customer off. So it's like, but I do think having something like that in place is helpful, especially again, if you have SBA, because SBA is personally guaranteed. If you don't pay it back, you can go like personally bankrupt.
Once you have all of the cash flow checked, tax return checked, you have an expert look at it, what is the next step of the purchase process?
Well, I think you go meet the owner and you have a walk through the business. You kind of develop a relationship with the owner. Depending on if you've kind of done all that confirmatory diligence, you go into the purchase agreement process, which and maybe concurrently the SBA raise process where you start engaging banks. But
when do you implement the LOI?
Generally, the process would be you find a deal, you send up an IOI, which is like an indication of interest. Hey, I'm interested in your business. This is generally the economics I'm looking at. And then that gives you time to maybe get access to his tax returns, get access to XYZ diligence to confirm your valuation. And then you send an LOI that's basically says, over the next 90 days, we'll negotiate generally in exclusivity, meaning he can't go and sell the business to somebody else during this 90 days. We'll negotiate a confirmatory agreement, a purchase agreement, which closes the deal. They call them definitive documentation or documents. But so generally execute the LOI, and the LOI will be more detailed. Will state, here's the purchase price, but it'll also state, things along the lines of, transition plan for the owner. What does kind of his role look like post close? Does he have a non-compete agreement? What are the, maybe a general view of fixed asset, maybe the purchase price allocation for tax returns? There's a lot of other things that potentially go in the LOI depending on how detailed it is. And then really you take that LOI and you hand it off to a lawyer to say, hey, can you make this a full kind of 100-page or however 50-page, definitive purchase agreement, asset purchase agreement, or depending on how you structure it.
And at that point, the SBA is all teed up.
Really, the SBA won't start having conversations with you real conversations until you have an LOI in place.
What other forms of financing are there?
It's very hard to get any traditional debt outside of an SBA on these initial deals. You can get mortgage debt. So if you buy real estate, you can put a mortgage on the real estate. And that's I won't say easy to get, but it's no different than buying a house. I mean, that's one of the benefits of buying a business that has real estate is some of the funding can come through mortgage. Seller note, which we discussed, is really basically like you'll pay some of the consideration to the seller over time with generally some interest rate. So maybe 5 years, 3 years, depending on how you structure it. I mean, so that really delays the purchase price. And then today there's like search funds, which is kind of like, equity participation in the deal where you'll go out and you'll raise, funds from search fund investors who give you money and then you give them a share of the upside economics. And that's become a lot more popular probably in the last several years. You basically can do a deal with very limited cash as the buyer. I found a really good deal. I'm going to go now market it to these search fund investors. And there's a lot of different ways to structure search funds, but it allows you to cover the equity check by giving them equity upside economics, depending on the rates you negotiate. But generally, those are the few. I mean, am I missing any that you're thinking of? It's really SBA, mortgage, seller note, and then various equity kind of.
The only other thing is if there's a seller note and you don't want to go up above a certain purchase price, you can add a earnout on top of that.
Yeah.
But I think you've covered all of it. And the earnout is just you hit a certain revenue or whatever benchmark you want to set, then a bonus structure starts to pay out.
Yeah, exactly. We had actually on the HVAC deal. So we sold majority control to a private equity roll up a couple years ago, and we had an earnout struck. The funny because the earnouts are set on usually your sim plan, which is just you're never going to hit. Financial forecast that you put in the sim is usually just like so astronomically high that you're like never going to hit it. And then the buyer will be like, well, that's a BS forecast. We're going to make it an earnout that you hit it. And we actually we hit the downside of it, which was an awesome outcome, which was like completely like all of us were like didn't even think we had a chance.
So you have the purchase agreement, it's checked off, you sign the paperwork, SBA funds, you own the company. What do you do?
Well, day one, I mean, it depends on kind of what the company needs. I mean, it depends your role in the company. It depends on what the owner's doing. I can tell you, so when we bought a transmission business 2 years ago, the first month, I basically was on site and got everything onto the cloud. So basically everything was, either paper-based or, very legacy desktop-based shop management systems. So transitioned all of their software. And some people would argue you don't do this on day one. Some people would argue like you wait some time, you get comfortable with the business. I think there's arguments to be made both ways. It was basically got their QuickBooks to QuickBooks Online, so you can kind of see everything on a cloud-based platform, transitioned to a SaaS-based shop management system. So again, you can kind of monitor from not being on site, redid their website, redid their kind of Google business profile, put up better pictures, set up a Google Ads structure, trying to think what else. And then obviously you have to transition like all of the bills and things to the new owner. You have to get a new credit card. A lot of like the bank has to transition to the new owner. There's a lot of we had a day one kind of diligence process plan with maybe 50 things in it. And you just check off those things. And you make sure everything transitions smoothly. There will be a ton of stuff that doesn't, even like transition employees. Like if you do an asset purchase agreement, you have to enter into new employee agreements with every single employee. So you have to go to them and have them sign a new employment agreement. All of their payroll changes. I mean, so like a lot of these things you're not thinking about. All of your vendors now have to enter new vendor agreements because now suddenly the entity that owns the business is different. So the entity that was previously on the vendor agreement is no longer there. And that's a lot of things, making sure like the vendor agreements, when you change, you don't lose the economics in the vendor agreement. So there's a lot of these just like block and tackling the first month. And then I think like month 2, you can kind of, we also gave kind of payroll or pay increases to pretty much all the employees, try to make everything transition well. And then month 2, you can kind of figure out, okay, what am I actually doing from an operations standpoint? Do I need to update my pricing book? What's the bottleneck currently in the business? How do I alleviate that immediate bottleneck? And then how do I what's the next constraint in the business? How do I alleviate that constraint? What's to just kind of increase your throughput? And then once you kind of optimized your operations, you can kind of go back to the marketing side. How do I increase customers coming in the door? And but generally the first month is just figuring out all this paperwork and getting everything on the cloud and making sure you're in the right systems. And again, some people will say, don't change, especially your shop management system right away. There's never a great time to change that type of stuff, but my general view is do it sooner than later. But
you mentioned something, and I wanted to go over this real quick. Asset purchase versus a stock purchase.
We're getting super technical here. The vast majority of these deals are probably going to be asset deals where you're buying the asset list of the business. So you're buying the fixed assets, you're buying the building that it sits in, you're buying IP. So maybe the existing website, you have a list of employees that need to transfer. The deal's contingent on the employee moving to the new entity. That's generally, so you're buying your assets in the business. If you do a stock deal, we actually, in the HVAC business, we did do a stock deal because of the vendor agreements, and probably because there were some other nuanced reasons. We had to actually do an asset purchase for tax purposes. So we got the basis step up. But in a stock deal, you're buying the entity as is. So you don't have to do all of this. Again, a lot of the stuff I was talking in month 1, the reason you have to do it is because you're changing the legal entity that all the assets sit in. Again, the vendor agreements, the employees, whatever agreements that have the utility on the building, all of that has to change to a new entity because, again, you're doing an asset purchase all the assets are moving to a different entity. So generally, I think from a legal standpoint, most people would say asset agreements are cleaner because if there's any legacy liabilities in the business, an asset agreement, you're just buying the assets and maybe some liabilities depending on how you structure it. And so if there's a legacy tax lien that hasn't been paid, it sits in the old entity and you're not structured. If you buy a stock deal and you find out a year later that the prior owner never paid his taxes, you're kind of stuck with that because now you own the entity that didn't pay taxes. Again, you can indemnify that in the purchase agreement, but that means you have to come back to the prior owner and you have the consideration to actually pay for those. So there's a lot of legal reasons. to do an asset deal. But I would say 95% of these small deals are asset deals, just for that, largely for that legal reason. And you get a step up in basis.
So you have auto mechanic shops, so transmission. What other areas are you searching for right now, or do you have a high conviction on?
This could go to like a whole hour on sell side on why I love transmission business so well. I think it's like a great space to play in, low competition, the great unit economics. That's kind of what I'm focused on right now is building out additional locations there. I think when you originally bought it, it was like, how do we get this one location to work? And now we're like, hey, like, can we build like at least a regional brand and go multi-state and move up into the commercial business and do kind of larger heavy duty vehicles. Love that space. And so I think when you find a good space and you have a business in it, like sometimes the best opportunities are investing back in that business. Because again, the best businesses are businesses that compound capital, right? That's what you're trying to find, is you're trying to find a business that is cash flow positive, and you can take that cash flow and reinvest it back in the business and make really high returns and consistently do it over and over and over again to grow profitably. And then suddenly, 2, 3, 5 years from now, you have a really good business. You have a bunch of awesome employees. When you're talking about these processes and you're talking about unit economics and you're talking about spaces you want to go into, obviously you think about initially, does the deal work? But is this something that I can turn into like a scaling machine and grow it, either multi-location or go into different customer verticals or grow it? And I think when you found that deal, like, why are you going out and looking at other deals? With that being said, I know we've talked about some of these other niche spaces like that are fun to go into. Some of them are auto repair. I think some auto, like collision, is kind of getting oversold, but there are definitely like kind of called like heavy duty maintenance. A lot of those, like trucking. I think there's these niche spaces, heavy duty maintenance for trucking or for maybe a heavy duty towing. I think is a good space, and it's CapEx intensive. I know you love septic. I think septic's so interesting, right? Because it's exactly what I was going back there. As you scale, your returns compound because you're like, as you get more density, as you get more trucks on the road, your utilization rate generally is going to go up as you get more customers. And so like, as you build out, your business gets more efficient. And so like, that's the perfect business to like get into with a couple trucks and then put your money back in and growing more. And then every single truck you get, your business is getting better. And so it's like kind of the perfect idea. And my understanding is it's actually more fragmented than you'd think it would be. I would thought it would be, but you're probably because of the regulations.
I think you're onto something with transmission.
The big issue with any combustion engine auto repair or the big kind of like long-term potential headwind would be EVs. And I guess they removed the EV tax credit last year, and EV kind of sales have largely stagnated. They're roughly, call it 1 to 2% of cars on the road a day. That number's growing. I think they're like 8% of actual new car sales is EVs. So obviously that's a steady state transmission that you're not rebuilding, and you're not doing a lot of the legacy auto repair, whether it's even collisions, because if your robotaxis aren't going to have the same collisions that a person driven car is going to have, oil changes. The market has kind of changed their views on those auto repair businesses and have been a little bit more interested in them than they were probably 2 or 3 years ago, when everyone's like EVs is going to be, all the road. I think it's a little market dependent. Like if you're in California, you're probably going to be a little more EV forward than if you're in Arkansas or if you're in South Carolina. People are going to want their trucks. So, and I think like even in these long tail businesses, like let's say EVs does become the majority of cars on the road in 20 years, that still is hundreds of millions of cars that you can service, right? Just because the industry is declining, I almost view that as a good thing, because it means less competition's coming in. Like less institutional money, big institutional money is probably going to play in there, because a fund, if you have $1 billion fund, you probably can't go buy these small fragmented businesses. It just doesn't make sense from an equity check standpoint. But if you're an individual, you can do it all day. So that's why when like finding businesses that are like niche that institutional money's not playing in is generally the advice I give to most searchers.
You're right. With Tesla is basically flat. Ford Lightning discontinued their truck. Where I think it's going to get interesting is the Tesla semis, because those are going to be autonomous and those are going to be electric. Now, are they going to be able to solve the EV charger? Can you get from the East Coast to the West Coast? And what are the laws around that? But I think that's where EVs are really going to make a big impact there. So I know, back to your heavy equipment, you still have earth moving equipment like dozers or graders, site prep. That's huge. So if you're servicing those and those diesel engines and those hydraulics, then that makes sense. But if you're servicing semis, where is semi repair in 10 years from now. I think it's a different market. I think it's
Yeah,
changed a little bit.
agree. I don't know that space probably well enough to like, but I do think the electricity and the kind of charging is going to be an issue, the batteries, but I'll probably be able to solve that. I know we're largely staying out of the heavy duty kind of tractor trailers, big dump trucks. We are moving into more, we call it medium duty up to like class 6 vehicles. So I think that's 26,000 pounds. So you're kind of like boom trucks and like tree trimmers. Those trucks, I think, are going to be around for a long time. And again, once you get those, you can kind of get fleet contracts and you can kind of build up a little bit more of like a quasi recurring revenue base or contracted recurring revenue base. But I think all those are going to be on the road for a while. So like getting into those spaces, I think is a really good, I mean, you've seen tree repair businesses have gone insane in the last few years. I mean,
It's needed.
yeah,
It's needed every month. It's needed on highways and
yeah.
everywhere, especially here in the East
But
Coast.
those tree repair businesses need to get their trucks serviced and they will for future. And a lot of that, there's just so much CapEx baked into their existing fleets that even if like a service comes out that, you know, could potentially replace their fleets, it takes a decade to actually like replace them. And again, if you're a business, if you're a small business with a couple individual owners, you can kind of operate in those businesses for a while and, you know, do very well, even if it's an industry that in 50 years doesn't exist.
So those businesses that have a bunch of trucks and semis, they're obviously asset heavy businesses. How does the SBA finance those?
The good thing about the SBA is they don't require like an asset heavy business to fund. They're not financing off collateral. They're largely financing off of the individual's kind of credit worthiness, you know, the business plan he's put together. And it's a program that is trying to get individuals to kind of be entrepreneurs. When we did it with the HVAC business, they didn't have any assets. So we didn't really have like, what is the fixed asset, you know, coverage.
But they didn't have like vans or trucks or anything?
They did, but they're so inconsequential to
Okay.
the cost of the business. I mean, we had a fleet of vans and we had inventory, but it wasn't an asset heavy, you know, machinery type business. We didn't own the building, so it was kind of more of an asset light deal. I would suspect that my understanding is in SBA is if you do have asset heavy, especially with real estate, you can kind of structure it where part of the SBA is guaranteed against the real estate or assets, and it kind of reduces your rate, and then half of it is based on basically the goodwill of the buyer, and you can kind of like get, you know, a blended lower rate or a blended better terms, different maturities, things like that, depending on your business buying. But again, I have never bought an asset heavy business, so I'm not probably the best person to tell you. But
how would you encourage people? I think the biggest thing that I learned at Wharton, besides the details of building a WAC or a positive NPV, Gordon growth model, those things are great. But I think the biggest thing I learned was, how do you get from the labor side to the capital side? There's risks involved. And so you have to take that step to get to the capital side.
well, I think capital side, but really just owning equity, right? I think like if you have, I mean, it depends where you are in your life and how much risk you can take on, but especially if you're younger and like if you have confidence in your ability to create value in your work, like you're working your 9 to 5 and you're saying, hey, I'm doing really well for this company. I'm creating value for this company. You need to move to where that value is rewarded in equity upside, where you're owning material equity. And when you do good things, that rewards you in upside and equity value. And so that may mean if you're at a small startup, getting options in the startup. And then that means that you're working your tail off, you're growing value through those startups. But generally, most corporate America jobs, unless you're like a senior exec, you're not probably going to get meaningful equity. And if it's equity, it's like small grants in a publicly traded company where your value is probably not like dramatically impacting the value of that holdings. Whereas if you have a small business, like you can dramatically improve your situation with your own work, own the equity upside economics. It's like dramatic on how much wealth you can create. I think that's like the people get in it, but it's also just very engaging and fun to own something you're working in. Whether it's like you with this podcast or someone who owns their business, or you're now like working for yourself and you're driven more, you're more motivated. And it's like a different type of work. Like it's not the mundane 9 to 5. And again, I think 9 to 5 works for a lot of people, but I think you need to have equity upside if you really truly are trying to create value and like work your tail off.
Yeah. Yep. Exactly. And so we're here to encourage that.
Yeah, in there. And I won't tell people to blindly do these deals, but if you're actually trying to do this, like do it. It's available to anyone. That's the best thing about buying small business. Like you don't need a Wharton MBA to go out and buy a business. I mean, it's helpful to have one. You get some structure. You kind of know people who have done it so you can use them as mentors, but you don't need it. Like honestly, a lot of these small business owners, view Ivy grads as pricks. So like they probably like people and trust people more who haven't got an Ivy League degree. You don't need these like credentials. You don't need to be an investment banker. You don't need to be like a high end. You don't need to have like Google on your resume, right? These things generally help. It probably means you're hired, you've done things right, but like anybody can really do it. I tell a lot of my friends this is like, just, again, it takes the initiative and it's risky because it could blow up, but generally most of these deals do pretty well. There's a reason, especially if you buy a business that's been around for 20 or 30 years, there's a reason it's been around for 20 or 30 years. It's because they're delivering a product or service that people need. And by you taking it over, especially if you have like a really good operational outline of how to improve it, there'll be some ups and downs. But over time, like it's probably going to do pretty well. Unless if you're buying a business that's needed, like the business that we've been talking about today, they're probably going to be around and they're probably going to do well. And you control it yourself, right? Like you can kind of like control your own outcomes, which is the dream.
These businesses that we're talking about can be intimidating to people, but if you have a passion for cupcakes, if you have a passion for coffee, those are great businesses as well. I mean, look at Baked by Melissa. She had a passion and she pursued it, and it was a great business. Just like you said, getting in to the market, learning it, and then doing it bigger and better. Just continue to grow. That's really important for folks to hear. You don't need a Wharton MBA. You can do this by putting in some work and learning.
There's a great Harvard Business School book on how to buy a business. I think it's called How to Buy a Business, right? Is that what's called? There's a lot of research. Just do your, especially in your first one, do your research, make sure you know all your things. But at some point, like you need to stop learning and stuff. A lot of times, the best way to do it is start reaching out to businesses, maybe publicly listed on BizBuySell or something, submit a couple LOIs, and just kind of start getting your feet wet and just kind of get in. I mean, it's obviously a big thing. Like it's a lot of risk, but generally the reward is worth it as long as you kind of done your work on the upfront and you know what you're doing, you have a good plan and you're willing to execute. I mean, it's just a ton of upside and it's a lot of fun too. I mean, I can tell you it's a lot of fun. Like it's motivating, it's rewarding to own your own thing and to kind of control your own outcome and develop relationships with your partners and your employees. And it's a really rewarding job.
Good. Anything else?
No, man, I love the conversation.
That was great. Thank you for going into detail. I think a lot of people are going to find this helpful, and just what I wanted to create here was a framework. Appreciate you coming on. Thank you. Thanks for sharing your wisdom, your knowledge, and your experience here.
It's been fun.
Legal disclaimer: the views and opinions and statements expressed in this podcast are those of individual speakers and do not reflect the views of their organizations or the producer. This content is for informational and entertainment purposes only and should not be construed as medical, financial, legal, tax, or investment advice. You should always consult appropriate professionals before making decisions related to your health, finances, business, or legal matters. References to any companies or services do not constitute endorsements. The producer and participants disclaim all liability for actions taken based on this content and make no representations as to its accuracy or completeness.